spot rates, forward rates, yield to maturity, blah, blah, blah. Everyone comfortable with what a spot rate is and what it does? Yeah? So when do we use spot rates, people? Valuation, right? Yeah? It's a discount rate we use to value cash flow in the future. It's a single discount rate. Well, it's a rate that's associated with maturity. Remember that? Cool. Okay, the spot rate curve. Right? Remember we construct this curve through bootstrapping, right? The instruments that we use there are those usually treasury bonds or risk-free, instruments. Forward rates. You're all comfortable with the definition and the use of forward rates? What is a forward rate? There's chocolate here, so if you guys answer my questions, I can distribute the chocolate. Yeah. Forward rates are what? The futures, expected future spot rates. Exactly. Forward rates also have a what? What does a spot rate have? A maturity. So forward rates also have a maturity, but they only apply in the future. Cool. Okay, yield to maturity. That's simple, right? It's a single discount rate that you will discount cash flows associated to a package of cash flows, right? For example, like a bond, 10-year bond. 10-year bond has cash flows over the next 10 years. Each of those cash flows you will discount at the yield to maturity, right? It's only, essentially, this over here is an indication of what, guys? This is something I'm looking for. I want the price of the bond, right? Right? The yield to maturity and the price of the bond are 1-to-1, right? If I know the yield, I got the price, I know the price, I got the yield. 100%. Okay, an expected return. How do I break down the expected return on a bond or any fixed income instrument? What are the components of return? Okay, so the capital gains and losses, yeah? The coupon, the current yield. What else is there? Okay, so you guys heard of the carry and roll down? The carry is the coupon component, yes? The current yield. Roll down, writing down the yield curve, yeah? The time component, if you want to call it that. And then obviously the capital gains and losses if the curve moves. So we got the duration effect, right? There's P&L from duration, yeah? Everyone? Also convexity, so we've got the parallel effect and we've got the non-parallel effect, convexity, okay, steepness, curvature, etc. And we've got obviously any currency gains, yeah? Also spread changes from credit spreads if they do change. All right. And again, okay, realized return is simple. We just know what the price of the bond I paid for today, and then what's the price of the bond when I sell it in the future. I can calculate the return there. All right. Everyone comfortable with definitions of interest rates? Fantastic. All right, cool. Okay. Now, calculation of forward rates, right? Like we all said, it's the expected future spot rate, right? Now there's a formula, right? You'll see this thing over here, right? But do we know how to generalize this? Right? What are the inputs into a forward rate calculation? Right? So two spot rates, right? Spot rates are associated with maturities, yes? So if I were to calculate, for example, this over here, I have a 3-year spot rate at 5%, 5-year spot rate at 2%. So what can I calculate there? Exactly, right? I can calculate a 2-year spot rate starting in 3 years' time. Yeah? How do I know what the maturity of that forward rate is? Right? I look at the difference between these two, right? Yeah. This is the long maturity, the shorter maturity. The gap between the two is 2 years. That is the maturity of the forward rate. When does it start? In 3 years' time. Got it? All right. Calculation of such is quite easy. Get the pin. Do you guys know the general formula? Do you remember the general formula? All right. So if I have, right, RT is the T spot rate with maturity, capital T. Should I use a small t? Yeah, small little t. Small t is maturity, little t. Equation of value. Okay, so what should the exponent here be? Yeah, exactly, right? It's the maturity of the forward rate, right? Yeah, everyone happy? Cool. Then how do I do some algebra here? Yeah. Okay, so what should the exponent of this term be? I want to calculate the forward rate. I'm getting to the formula, right? I just want to see if you guys understand the formula of the forward rate. So I'm doing algebra. This is the equation to determine the forward rate. Everyone happy? Right. How do I determine now? Okay, so I took this term, I divided it by this term, or this term divided by that term. What's the exponent of this expression? 1 over t minus t, yeah? And then I subtract 1, and then I've got the forward rate. Okay? That's a generalized formula. Easy to understand. You don't need to know this. As long as you understand this line, you understand everything, right? Yeah? So, all right. Okay. Bootstrapping. Okay, guys, so far so good, right? Everyone happy? Yeah. All right. What's bootstrapping? Come on, huh? Almost there, almost there. All right, bootstrapping. I'm going to take, what do I have in the market? I've got bonds, right? I've got some sort of fixed income instruments, right? Okay, there's a valuation associated to those bonds, right? How do I get to the valuation, right? You guys would have normally taken the yield to maturity and discounted all those cash flows, yeah? Okay, I've got a price of a bond, right? That's easy. What's the equation of value? How do you value anything? You discount future cash flows, right? Discount those future cash flows at what rates? The spot rates, yeah? Okay, so if I got the price of the bond from the market, I know that the equation of value is the future, well, the discounted future cash flows, right? And I'm discounting those cash flows at the spot rates. So that's exactly how I bootstrap, right? I want to determine what those spot rates are such that I can recover the price of the bond, right? You always start with the instrument with the shortest maturity. Typically, it'll be a 1-year bond. You get your 1-year discount, well, your 1-year spot rate. Once you have that, then you can start to build forward, right? Then you can determine what your 2-year spot rate will be from a 2-year bond price, and the 3-year spot rate will be from the 3-year bond price. Make sense, everyone? All right, cool. So if we look at this example here, right? You've got the following information. You've got a 1-year par rate, 3%. Okay, so par rate tells you what, guys? What information is this giving me besides the yield? The cash flow, right? The coupon, right? Because it's par. Okay, so what's the price of the bond there? 100, yeah. Okay, so there's a 1-year par rate, 3%, 2-year par rate, 3.3%. Okay, now, another price of the 1-year bond, right, is at par, it's at 100. So now 100 is equal to, write this out here, 100 must equal, right, what? It's a 1-year bond, right? So, and it's paying a 3% coupon. So what's the future value? 103. And now I have to discount it at the 1-year spot rate for how long? 1 year. So now I can determine R1. Everyone happy? Cool. Then I go back to my information. Right? But now the price of a 2-year par bond, right? It's equal to? What's the price of a 2-year par bond? Equal to 100. Yeah. I'll go back here. This is for the 1 year. Then for the 2 year, right? I know 100 is the price of the bond. I know it pays 3.3% coupon, right? In year 1. So I'll discount that cash flow at the 1 year spot rate. And then what does the bond redeem at? Par, right? So then I get par plus coupon, right? And this is discounted at the 2-year spot rate. You're happy? No? All right, that's understood. Okay. Now, in this entire equation, right? What do I know and what don't I know? R1, do I know this one? Yeah. Right? How do I know this number? I solved it up here, right? That number there is unknown, right? So I'll solve for it. So now we're starting to build term structure. Starting to build a curve now, right? I've got the 1-year rate associated, 1-year maturity, and I'll determine from the price of the 2-year bond, the 2-year spot rate. Everyone happy? And that's essentially how we bootstrap. Okay? So obviously, we add more bonds, 5-year, 7-year, 10-year, blah, blah, blah. I'm able to determine 5-year, 7-year, 10-year spot rates. All right? And then to sort of like, the gaps in between, what do? I'll interpolate for what I don't know. Yeah? Doesn't have to be. Yeah, well, typically in the market, right? For bonds, it doesn't have to be. Right? Because unless, for example, if it were on the run treasuries, so that, for example, if the US Treasury had to like sort of tap on the same issue, they'll issue at par. No, won't issue par. They'll issue at the same rate that was issued originally. If it were freshly issued bonds, it would be issued at par. Doesn't have to always be par. As long as you got the price of the bond, right? For now, the price was par because they told us it's par. But if I tell you the price of a 2-year bond that pays a 5% coupon, they say 95, you use 95 here, right? Okay. Everyone happy? Any questions? No. Cool. All right. Evolution of spot and forward rates. Okay. Were you guys comfortable with this when I explained it? Did you guys understand what I was trying to get at here? Right? So, what's the most important bit over here? When it comes to fixed income, what's the most important bit? Do I care about the spot rates or do I care about the forward rates? Right? I care about the forwards, right? Because why? I want to know, right, in terms of the return that I'm going to earn, right? I want to know, more or less, what is my expected return going to be in the future? And it's not dependent on what I know now. It's dependent on what's going to happen in the future. The spot rate gives you information. Yes, it gives you information about what the rates are now. Also allows you to take a peek into the future of what the market thinks the forward rates are going to be. Yeah? Everyone? That's the base case, right? And obviously around the forward rates, you make your assumptions. Okay, I think the future rates will be either go up, go down, right? I can link it to some volatility if I want to, but that's the idea, right? It's about what the forward rates are doing, right? Questions? No?
It should be recorded.
Am I not recording? Not recording? Okay, so look at this table. So what does it say? If the actual spot, okay, now this is important, right? The forward rates are the indication of future spot rates. Now I'm going to buy my bond, right, with my assumption of what the forwards are going to be. I'm going to hold it to, like for a year or so, right, into the future. Then I want to actually look at that period of the forward that I calculated initially. I want to compare that forward initially to what the spot rate is now. Does it make sense? So if I just draw a timeline, right, say, okay, this is time 0, time 1, time 2. At time 0, right, this is a forward rate. You agree? This from here to here is a forward rate, right? Okay. What's the maturity of this forward rate? 1 year, right? That's relative to today. Now, I'll buy my bond and I'll hold it for 1 year, right? What does this new rate become over here? A 1-year spot rate, right? You guys agree? It's starting here, it ends there. Well, this is the starting point, right? Therefore, it's a spot rate. So I compare that forward rate, which is relative to this point here, to the spot rate, right, after 1 year. Okay? That's the idea, right? And if the market was correct, right, what do I expect? These two are equal, right? Yeah. I expect the spot rate in the future to equal what the forward is, because that's what the market expected, right? Now, obviously, it doesn't work that way, right? So you need to make an expectation of this guy, and then actually determine, well, when you get to this point, see what this was, right? Okay, cool. Now, if the actual spot rate over here, question? Okay, so must I come here?
No,
Okay, all right, okay. Now I lost my train of thought. Okay, look, okay, so actual spot rate versus implied. Now, when they talk about the actual spot rate, right? They're talking about the spot rate over here now. Yeah, I bought my bond, right? I've held it for 1 year, right? At this point over here, the forward rate was, right? When I calculated based on the 2 and the 1 year spot rates in the market then. After 1 year, right? This rate that applies from year 1 to year 2, right, is now a 1 year spot rate. You agree? Right now, I will compare what the forward was initially to what the actual spot rate is now. So the actual spot rate here versus the implied forward rate. If this rate is lower, what does that mean? Just before we get to this, what does that mean? In the beginning, you said this rate. Okay, say for example that rate was. Say this rate in the beginning was 5%, right? But now, after 1 year, right? This is now. Okay, so it's got a 1 year maturity. So I'm going to do that. Say this were 6%, right? So initially, right, you said it's 5%, but it turned out that the rate was higher, okay? It means that the yield curve, at least the interest rate over here, had gone up, right? But it's gone up, right? Based on the forward rate, right? Not based on what you know now. You're not making any assumption about the rate changes now, making an assumption about the rate changes in the future. If that rate had gone up, right, what would have been the best thing to do? If you expect the rate to go up in the future, what would have been the best thing for you to do? You would sell bonds, right? Sell bonds forward. I can sell a bond forward at 5%. Yeah. What do you guys know about bond and yield? If the yield goes up, the price of the bond goes down. So if I had to sell my bond here, right, at this rate, I fix it 5%, and it turns out the forward rate, well, the spot rate in the future ends up to be 6%. I gain, right? I gain because I went short, got rid of the position, well, sell the bond, right? And there's a capital gain of 1% here, right? Or 1% on the duration. So that's exactly what you're going to do. So at the end of the day, you're making your determination on rates, but not based on the spot rate, but based on the future spot rate, which are the forwards. Okay. So if the actual spot rate were higher, right, the forward price will decrease, right? Because why? Higher rate, lower price. Therefore, what would you do? You sell a forward contract. You lock in that rate now, right? Because you expect the rate in the future, the spot rate to increase. Got it? Same argument for if this rate over here were lower than the forward, right? You know that if this interest rate over here, the actual one is lower than what the forward sort of suggested at the beginning, what would you do, guys? You buy forward. You buy a bond where? You buy a bond nicely at 5%, right? And because of the compression of the yield in the future, you're going to realize a capital gain. Happy? Well, essentially, exactly, yeah. Well, in this case over here, because of the yields, you think of the opposite way. You think in opposite terms. So for the yield, you always buy high and sell low. Yeah? For bonds.
Yeah, but the price wise.
Price-wise, yeah. Okay. Everyone happy? Have I confused you? Ah, sweet goodness. All right. If you want me to do the questions, just stop and say, do the question, right? Then I can also test the understanding. Okay, so now this learning outcome statement, writing the yield curve, this is very easy. There's nothing difficult about this, right? First of all, what does it mean to write the yield curve? Okay, no, expectation. No, okay, no, you almost. Okay. When I spoke about the expected returns right at the beginning, right? What are the components of return? There was the carry and roll down. There was the curve effect, right? The capital gains and losses. The carry and roll down. The carry was the coupon. The roll down was the time effect, right? Perfect. When you write down the yield curve, what are you assuming? Say I have a yield curve here, right? And this point here, and then I want this color there. Okay, so this is a 10-year, 9-year. If I buy a 10-year bond, right? Say for example, yeah, right. I initially buy a 10-year bond, right? Yeah, everyone happy? I buy it 10%. I hold it now for 1 year, so that 10-year bond has now become a 9-year bond, right? If I go to the yield curve, where's the yield for the 9-year bond? 9%. So if I value this bond now, right? Sorry? Yeah, so if I value the bond now, I'm valuing, right, the future cash flows at 9%. Correct. Now you can see that I bought it at 10%, and now I'm valuing it, now it's now valued at 9%. So you can see that 1% drop in yield implies what? A price increase, right? Okay, so why do I get the price increase? Did the yield curve change? No, the shape of it didn't change, right? That means that in terms of its maturity, the 10-year yields, right, still remain at 10%, right? But even though I bought a 10-year bond, right, and I held it for 1 year, now it's a 9-year bond, it don't matter because why? The yield curve still remained the same. That's called writing the yield curve. So you buy up here, right? You hold it, the yield curve does not change, and only what changes? The passage of time. And then you value here at 9%, and you make a gain. Now, what you were saying, you buy a bond with a long maturity, and then you have an investment horizon. Yeah, it can work. Yeah, it can work. Why? Why would you do that? You buy bonds with the higher yields. Why? Because they're cheaper. Yeah. And then you sell them. Yeah. And as you roll down, right? You value them at a lower yield. But also, right, when you go down the yield curve, The long maturity bonds also have what? I'm looking for two things. High duration, right? And also possibly higher, no, not default, convexity. Yeah? Longer the maturity, right? The higher higher the duration, higher the convexity. So when you're buying these bonds and the yield curve does not change, does not what's the word? Does not change, right? You're at least over here, you're buying the bond cheaper to the high risk. Yeah? All right. Okay.
So on this graph, when do you sell it? When do you get that?
The investment horizon is 1 year, right? You buy a 10-year bond, hold it for 1 year, you're valuing about 9%. So you basically made this. So 1% times the duration of the bond is your P&L, right? And this is purely based on time.
And this is also showing the expectation is forward looking, I mean upward sloping.
Oh, yes, so this strategy would be for an upward sloping yield curve. Now, if it were downward sloping, you do the opposite, right? You would, yeah, you want to sell here and then buy it back. Well, you want to do the opposite. You want to sell it there and buy it back here. Yeah. All right. Okay, cool. Any questions? No, okay, cool. Am I going too fast? All right. Okay, so now we can plot the bonds.
Is that basically saying that by buying a bond, you automatically getting, as long as it's an upward sloping curve, over time you will gain that value?
Uh-huh.
That's all it means.
Uh-huh. Yeah. So look, when you guys, okay, so when you get to level 3, you can do this thing called attribution, right? So like I said, your expected returns of the bonds, you can actually do it, well, you can take any realized return and break down that return into various components. So you start off with the easiest one that you know, which is the current yield, which is just the cash flow on the bond. It's easy. Then you've got the duration. You can monitor, okay, what is the yield at this point when I bought it? What is the yield when I exit to the position? That change in yield will contribute to the duration, right? P&L or return. But the assumption is purely by the passage of time, right? If nothing in the world changes but time, and time is forever gonna, move by, right? You are going to buy the bond here, and the bond will basically increase in value, right? Because of the fact that you're moving down the yield curve to a lower yield, right? Another thing also is discount bonds, for example, right? That's also a good example of writing the yield curve, you want to call it that. Discount bonds are what? What happens to a discount bond, right? It pulls to par, right? Can you guys see that? So that's exactly what happens as well, just purely based on time, right? If I buy a bond and I'm holding it, I will still, if I buy it at a discount, every day it's actually accreting in value because it has to pull to the par value. Got it? So that goes, carry and roll down analysis, all that information gets calculated. Yeah. Okay. So we can now park the bonds. Now we're going to move on to swaps, right? Okay, so explain the swap rate curve and how market participants use it in valuation. Okay, everyone understand what a swap is? Yeah? How does swaps work? Right, fixed for floating, etc. Right? One leg is fixed, yeah. The other leg is linked to some benchmark interest rates, whatever we call that, the floating interest rate, right? LIBOR, JIBOR, whatever you want to call it. Okay, cool. When you trade a swap on day one, what's the value of that swap? Why? Sorry? Yeah, but why is it zero?
Otherwise, the other party wouldn't enter the contract.
Okay, fair enough, right?
Yeah, because your fixer that you fix, you have to be what the price what that you get floated.
It's value based on what the fixed floating rate gets.
Almost there. So what you do is the swap rate, right? What don't you know? What's the unknowns? The floating rate, right? I don't know what those things are. I know that, okay, the cash flows on the swap must be linked to whatever the future forward rates are going to be. Yeah? Because you're going to treat those future cash flows as forward rates, right? Based on forward rates. Okay, cool. When you design the swap contract, right? And most derivatives that you're going to encounter besides options, right? When you design the contract, right, it has to be fair on both sides, right? I know on the fixed rate, I know what that rate is, right? So that I can determine the value. But on the other leg, I don't know what the value is. And for the contract to be fair, right, I need the value of the two legs to be equal to each other. So you guys would have heard, hopefully, that the swap itself, if you had to just write out its equation of value, I receive cash flows. If I were receiving fixed, I receive fixed cash flows. So I receive the fixed leg, and then I fund the fixed leg with the floating leg, right? That now becomes a liability, right? So I'm paying the floating cash flows, right? So the PV of the fixed leg minus the PV of the floating leg is essentially your equation of value, right? On day one, it has to be fair to both parties. Therefore, the PV must equal to 0. Therefore, the PV of the fixed leg is equal to the PV of the floating leg. Does this sound familiar? All right, cool. Now, that's number one. So when a swap trades in the market at par, it basically means that the PV of that swap is equal to 0 on day one when you trade. When the PV is equal to 0, what do I determine? The fixed rate on the swap, right? It's that single rate that makes the swap fair to both parties, right? Okay, it's that single rate that makes it equates the PV of the fixed leg equal to the PV of the floating leg. Everyone happy? Right. Do you remember the formula of how to calculate it? I'll show you. Okay.
Did it yesterday on derivatives.
Ah, okay, cool. Okay, so we explain what the swap curve is. So elements of the swap curve. Okay, we spoke about that one, right? Okay, why do we use swaps, right? Over bonds. So at the end of the day, right, a swap works just like a bond. The only difference is what? Sorry? Oh, 2 legs, but what else? Okay, so first of all, when you take a bond. This is very important. Take a bond. What does a bond do? If I buy a bond, what do I get? Get cash flows, right? I'm going to receive future cash flows, right? Now, automatically when those cash flows are fixed, right? What do I pick up? What type of risk do I pick up? The duration risk, right? Whenever you have fixed cash flows in the future, automatically, because you have to value those things, right? Automatically, you're going to pick up duration. Think about it, right? You're going to pick up duration. Now, on a swap, if I'm receiving fixed and paying floating, right? If I receive fixed cash flows, I pick up duration risk. Happy. So I have some exposure to interest rate risk. On the floating leg, right? Do I have any exposure to interest rate risk? Why? Resets, yeah, but okay, there is reset risk because why? The cash flow, when it resets, the next cash flow is fixed. Remember that, right? I have to value that fixed cash flow. There is some risk on that fixed cash flow. The future cash flows after that one, it's unknown, right? In a sense, almost there. We have to. What do I need to do? I need to estimate what those cash flows are, right? In order to value this thing. Where is the best estimate of what the future forward rates are, or future spot rates are going to be? The forward rate curve, right? And where do I get the forward rate curve from? Exactly, the spot rate curve, right? So all that stuff you guys learned of bootstrapping, whatever, it's coming back into the picture here, right? It's easy to value a series of fixed cash flows. I just discount them at the spot rates. Done. The forward rate curve, slightly different, right? The floating leg of the swap, slightly different. Those forward, all the cash flows in the future are going to be based on the forward rates, right? In the future. I get that from the spot curve, right? Now, if I'm using if I'm using one curve to estimate cash flows and discount cash flows off, will I pick up any risk? Think of it this way. What is interest rate risk? It's risk that the spot rate or whatever changes, correct? Yeah. Now, if I'm estimating a future cash flow based on this curve, say for example, this is my yield curve here, and then now it changes, say it does this thing over here, right? So you guys all agree that if the yield curve goes up, the valuation should come down. All right, cool. Now, the cash flows themselves on the floating leg on the swap, right? They're determined off the forward rates that I calculate off the spot rate curve. Happy, everyone? Now, if the spot rate curve shifted up, right? What happens to the forward rates? They'll also change. Now, think about it. Like I said, do you expect there to be any risk, right, in valuation if I'm using the same curve to discount my future cash flows and determine my cash flows from? There should not be, because why? You actually take that into account. If the yield curve shifted up, I redetermine what the cash flows will be. So there's no risk. So the floating leg on the swap carries no interest rate risk, right? No interest rate risk apart from the fixing that's done on the immediate cash flow. Got it? Okay, so now, long story short, I compare the two instruments. A bond has duration. Happy with that. Easy. A swap, does it have duration? Okay, how do I determine the duration on the swap? Swap is a fixed for floating. I receive fixed pay floating. Receiver leg on the swap is like the bond because I'm receiving fixed cash flow. Do I pick up duration? Yes. Look at the floating leg on the swap. Do I pick up duration? No. So I get exposure to duration risk on a swap. Everyone agree? What did it cost me? 0. So you use swaps for exposure to duration, right? And you take leverage on the swap. Because it costs you nothing to enter into the swap, right? But you have exposure to interest rate risk, right? We're happy. That's one of the uses of swaps. The other uses of, besides the whole sort of transformation of cash flow thing, if I were to hedge my risk, like I told you, the floating leg on the swap carries no duration risk. So if you were worried about interest rate risk, say for example you had taken out a fixed rate loan, right? You have to pay fixed rates on your loan, right? And you're worried about future interest rates. You can hedge that future interest rates by going into an offsetting swap, where you transform the cash flows from fixed to floating. Exactly, yeah. So depending on what the obligation is, right, you structure the swap to negate the fixed rate legs, so you immunize that risk, and you're left with a set of floating rate cash flows that are not interest rate sensitive. Got it? Cool. Okay, cool. That's the uses and whatever. Then there's some other stuff there as well. And okay, so how do we construct the spot curve? Well, at least how do we construct the swap curve or the spot rate curve for swaps? What's the word? It starts with a B. Bootstrap. Remember the bootstrapping procedure, guys? Right? You always break it down to equation of value. What is it for a bond? I know the market price of the bond. What is the equation of value of the bond? It's the present value of the future cash flows, right? A present value future cash flows at the spot rates. That's how I determine the spot rates. For swap, same thing. It's exactly the same thing. So what you're going to do, you're going to say for the swap, what's the present value of the swap? It's the PV of the, okay, say for example, I'm receiving fixed, PV of the fixed leg minus the PV of floating, right? Now, when they give you the par swap rates, what is the par swap? What is the value of a par swap? What's the value of a par swap? 0. Yeah, everyone happy? Yeah. Okay, so they give you the par swap, right? The PV is equal to 0. So they give you par swap rates, right? Automatically, you know all the PVs for the 1 year swap, the PV of the 2 year swap, they're all equal to 0. All happy? Right, now, again, like we said before, right? So the value of the swap, we'll call it V, is equal to the PV of the fixed leg minus the P of the floating leg, right? PV of fixed minus PV of floating, right? I know the valuation is equal to 0 because it's a par swap rate, so I just write that out. Okay, so that means PV fixed is equal to PV floating. Okay, now on the fixed leg, on the swap, what do I have? Okay, yeah, that's true, but how do I value it, right? It's the present value of the cash flows, right? So it's the sum of whatever the cash flows will be, which is the swap rate, times the notional, times blah, 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 right? Times, right? How do I determine the interest on the swap, right? I know the period, right? Typically it's like 3 months, yeah? Right? Because why? The benchmark rate could be 3-month LIBOR, therefore I know that the cash flows will be based on 3 months. So I'll call this thing, right? For now, I'll just call this thing small delta, right? I, right? Because it's that 90 days over 365 times what? What am I doing here? I'm discounting, right? So there's a discount factor here associated with the time it's paid, right? Now, on this end over here, how do I value the floating leg? So what do you guys know about a floating rate instrument when it's valued on a reset date? It values to par, right? Okay, cool. So automatically, right, I know that for a floater, it values to par. But then also, I know that this floating leg over here, right, is only a series of interest payments, nothing to do with principal exchange, right? So the value over here is, I'm getting to the swap rate calculation. This should look familiar, right? 1 minus the last discount factor, right? Now, in this case over here, right, you see this term over here and this term over here, right? Very simple. DFI, right, it means all the cash flows up until time T, the maturity here. So starting from, if I look over here, say for example it's a 1 year swap, right? it's a 1 here, and 0 here, right? So I look at the discount factors that apply from time 0 to time 1, right? And I look at the final discount factor, right? And then that's how I determine what the swap rate will be. So for 1 year swap, it's very simple, right? It's going to be the swap rate, whatever it may be, times, say, 90 days over 365, multiply by 1 plus 1 year spot rate for 1 year was equal to 1 minus 1 plus, and I can determine what my 1 year is. You guys see that? Solve the equation here. Got it? Okay, that's the 1 year spot rate. Fantastic. For a 2 year swap, right? For the 2 year swap, it's a sum, whatever the 2 year swap rate was, times say 90 over 365, times the discount factor, right? So this is I equal 1 to 2, must equal 1 minus df2. Write this out, right? This is going to be the 2 year swap rate, so this will be R 2 year times 90 over 365 times 1 plus R1 plus
And does it matter if you use the 365 or the 360, will it tell you?
whatever they tell you. Whatever they tell you. Okay. Does this look familiar now, everyone? I'm just peeving cash flows, right? Okay, so on this on the fixed leg, right? You see this bit over here? What do I know and what don't I know? I know R1, right?
Yes.
I don't know R2. Correct? And this line over here, this expression, what do I know R2? No. So what am I solving for essentially? R2. Can you see how I bootstrap now? I use the 1 year swap, I got the 1 year swap, 1 year spot rate. I'm going to use a 2 year swap, right? And I'm going to determine what the 2 year spot rate will be. That's how you bootstrap.
On the lessons of the question, is it still 101?
0.
Zero.
No, but that's the reason why these things are equal.
Okay.
Remember, the PV in the swap is the present value of the fixed minus the present value of the floating. Right? At initiation, the value of the swap is 0. Therefore, the two legs are equal to each other. Hence why there's an equality here. This is the PV of the fixed leg, that's the PV of the floating leg.
Okay.
Cool. Any questions? It's nice and easy. It's just technical. All right. Okay, any questions, guys? I just did an example. you can do this. Use this, right? This is exactly the same thing. Make up numbers. Say the 1 year swap rate R1, right? Call it 5%, right? And R2, call it say 7%, and then calculate what your 1 year spot rate will be, or what your 2 year spot rate will be. Right? Okay. No, it's all here. Just plug in numbers. All right. All right. Okay. So now we've got two curves now, right? We spoke about spot rates, right? One coming from treasury bonds, the other coming from swaps, right? Coming from the swap market. Now, question. Treasury bonds, do they carry any risk? Well, credit risk. No, right? So basically, that's like your kind of your benchmark for a risk-free rate, if you want to call it that, right? Swaps, do they carry any credit risk? They do, right? They're very happy, right? It's because why? Who trades swaps or who writes swaps? The banks do, right? The banks carry their own risk exactly. So banks are at risk of defaulting. Governments not so much because they can always print money and do whatever they need to do. Right. Okay. Now we got two curves. You got the swap curve and you got the bond curve, or bond or treasury curve, right? Now obviously, like we said before, right? Because the swaps carry credit risk, the swap curve should lie typically above the bond curve. Does it make sense? Right. Okay. Now swaps. Now we can talk about spreads, right? So now this thing called the swap spread. Okay. Now the swap spread it's very simple, right? You look at where the swap curve is, you look at where the bond curve is. Done. Now you pick a particular maturity and you go and say, okay, fine, on the curve, if I look at a 10-year bond and 10-year swap, right? What is the spread between the 10-year swap and the 10-year bond? That's not difficult, right? Okay. Swap spread is the swap rate, right? From or rather from the okay, so read this quickly. Okay, so we've got spot curves and we've got yield curves. Okay. For bonds, right? got the treasury spot curve. And then the yield curve will be the yield to maturity. Like you mentioned, the par yields, right? So you can take all the par yields, right? If I know the par yield, I got there. What's the price of the bond? It's 100, right? It's par. So for every maturity, I know what the yield will be. So there is a curve associated with that yield to maturity. For a swap, I can calculate the swap spot curve, remember? And the spot curve is only used for what, guys? For discounted cash flows. But in terms of a yield curve sort of analog, right? It will be the par swap rates, right? Everyone happy? Okay. In the market, swaps trade over here. They trade on the rate, right? A 1-year swap is 5%, 2-year swap is 7%, blah blah blah. I basically take all those rates and then I link it to the maturities that they apply over, and I can build a curve. Much like I built a yield to maturity curve for bonds. Everyone happy? Okay. Now the swap spread calculation, right? Starts with what? Identify the maturity you're looking for. Okay, so for example, in this case, I said it was 10-year. So all I'll do is I'll say, okay, fine, the swap spread, which I'll call SP. No, how do you spell swap spread? Sorry. I'll call that spread, whatever. Alpha is equal to the yield to maturity, right, of a 10-year bond minus the 10-year par swap rate. Oh, sorry, my bad. Other way around. You're not happy? That's it. Okay? As simple as it is. Now, I spread. Okay, sometimes you may find that I want to calculate, I don't know, say a 11-year swap spread, right? I've got an 11-year bond, but I may not have an 11-year swap. Everyone happy? Yeah? So how do I determine what the 11-year swap rate will be? Okay, so I'm going to interpolate, right? If I know what the 9-year swap rate is and say the 12-year swap rate is, I can interpolate for the 11-year swap rate. Make sense? Okay, now I've got an 11-year swap rate, which I just interpolated, right? I can compare that 11-year swap rate to the 11-year yield to maturity on a bond. And the gap between the two will be the I spread. Same thing. Got it? Everyone? All right.
Why does it say flex on liquidity and creditors? Liquidity, I mean creditors like that.
Remember sometimes what you find is sort of like, okay, so in the market, right, you've got benchmark instruments. So in the interbank market, when they trade, right, so typically, right, they're going to trade, like, you know, 2-year, 5-year, 10-year, 12-year, blah, 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 right? You find that, for example, if you're looking for an 11-year swap, it don't trade in the market, right? So if someone is now going to trade an 11-year swap, right, it's going to carry a liquidity premium, because why? If I'm going to trade this thing, right, there is no, I can't, like, for example, bank, if you had to go and write an 11-year swap, he's have to go and ask the rest of the market, hey, I need an 11-year swap to hedge this. And the market don't trade 11 years. And if they do trade it, they're going to add a spread to it because of the illiquidity, right? That's where that's coming from, right? Okay. All right. Okay, so Z spread. Okay, what's a Z spread? Okay, no, starting point is definition. But what is it? Okay, also another characteristic, part of the definition. But what else? Okay, almost, yeah? So I will take a very generic example. Say there's a bond in the market, MTN, right? Whatever, right? It has 10 years to maturity, correct? MTN trades at a spread over the government's sort of benchmark rate, right? Okay, fair enough, right? So there's a credit spread attached to it. Now, bear in mind that this bond, right, is for 10 years. The Z spread calculates the return, right? Well, basically the excess return over, like you mentioned, the risk-free rate, right, that you will realize if you hold the bond to maturity. Okay? Remember the calculation of Z spread? You mentioned, what did you mention? Zero volatility. No, other one. No, someone else mentioned something. You hold it to maturity, right? Okay, fair enough. So now, as I said before, right, it's a spread that you will earn. It's like a credit spread you'll earn, right? But the assumption is you hold the bond to maturity. With all valuation, what do? You're discounting future cash flows, right? So this time 1, time 2, blah, blah, blah. So this is time 10, right? Now, how do I value the cash flow, people? I discount it, right? At the spot rate, correct? So if I discount all the cash flows, I'm going to get what? I'm going to get the price of the bond. So the price of the bond, right, is equal to, again, this is the equation of value, whatever the cash flow may be, right, at that time that occurs here, right? A discount, right, at the 1-year spot rate. Everyone happy? Doesn't have to. Add the Z spread, or add a spread, because why? It needs to reflect the risk. Because why? This counterparty is risky. Yeah? The only reason why I trade this thing is to earn that extra spread. I'll to earn the extra spread because why? I'm taking on now specific risk, taking on credit risk, right? It's a constant spread that you will add above the treasury spot curve, right? And you'll discount like that. And then this one over here, you do the same thing. Everyone happy? That's the equation of value, right? Do I know the R1, R2, R3, blah, blah, blah to R10? I do. Comes from my treasury spot curve. Everyone happy? Do I know the Z? No. Do I know the price of the bond? Where do I get the price of the bond from? From the market, right? The market, this is what the market says the price should be. So I stick the price here, say the price was say 97, hypothetically, right? 97 is equal to this, all this nonsense. I know all the spot rates, I just don't know what the Z is. And I solve for that Z. Goal-seek, whatever you guys want to use, or the calculator. And then you'll basically determine this, right, spread above the spot rate curve, right, that values the cash flows to the market price. And this spread over here is the return that you will earn, the excess return you will earn above the spot rate curve, right, above risk-free, right, for taking on this particular risk. Assumption is that you're going to hold the bond to maturity. Second assumption, right? There's no volatility in interest rates, right? The fact that I can do this cash flow discounting, right, means what? What am I assuming? Apart from the spread being constant, what else? Sorry? No. What else am I assuming over here? That the path of interest rates don't matter. Volatility dictates the path of interest rates, right? Over here, there's zero volatility, meaning that I can then do this discounting of future cash flows using this DCF model, right? Very important. In the absence of volatility in interest rates, I can do this. That's why I calculate the Z spread. What is the definition of Z spread? Zero volatility spread. Zero volatility in the interest rates. Got it? Assumption is also I hold this bond to maturity. Can I use the same formulation to calculate a spread on a callable bond, for example? I cannot, right? Right, so this is, so reason why can't I do that? Right, so you're all saying the same thing, but the key thing over here is, right, over here, right, that volatility does not affect the path of interest rates, right? The assumption is I'm holding this to maturity. That means I'm making an assumption at those points in time, I am going to receive my cash flow of C, right? Everyone happy? Okay. So this is that spread. Again, like we said, it's a static spread. It's a single spread I apply above the entire spot rate curve that I discount the future cash flows at to recover the market price. Okay, so we set that there. Okay, we got that there. Where did you get LIBOR from? There's no LIBOR. Where's LIBOR?
No, not LIBOR. I mean, for any reference for that matter, should you take the shortest maturity? Is that how the debt spread is calculated?
No.
The debt spread.
Okay, let me ask you a question. Is there a Z spread for government bond?
Debt spread.
The debt spread?
Debt.
What spread?
Debt.
Oh, no, man. Okay. Sorry. Sorry. Okay, I'll get there now. Zero volatility spread. Be happy, everyone? Guys, happy? Sweet. Oh, I'm running out of time here. Okay. Okay, cool. Okay, so hedge spread definition, easy. 3 months. Okay, so we're basically looking at 3-month LIBOR and 3-month Treasury bill. Okay, very easy. One is risky, one is risk-free, right? Treasury bill risk-free. The 3-month LIBOR carries risk from the banks. So essentially, what this is going to measure will be short-term credit risk, but also it can also measure some degree of, well, just short-term credit risk. This one over here, right? The LIBOR OIS spread, right? Now, LIBOR, right? Bank rate, okay, easy, right? Has a particular maturity, 1 month, 3 months, blah blah blah. So it's a term here. OIS is an overnight rate, right? So now, in terms of liquidity, if you want to call it that, right? This spread over here, because remember, these are both kind of like bank rates in a sense, right? The OIS market is still, it's still in the bank space, as well as the LIBOR market. So this particular spread is going to measure some degree of liquidity, right? Not liquidity, credit risk, very small, but it's more got to do with liquidity, right? Everyone happy? The bigger the spread, the more liquidity risk it could be, right? So in terms of like, for example, banks, right? Banks, typically, if you see the spread shoot up, means there's a bit of a liquidity problem, exactly. So you find that people, right, they don't want to take sort of this term risk, they're more happy to be in the OIS space, right? Okay. Interest rate theory. Okay, so at the, oh guys, this is the long section. Okay, has anyone got questions on this? You guys understand this one? No, because I can spend hours talking about that. I don't want to waste time. Right. Okay, so modern term structure models, right? Any questions on this? Yeah, figured. All right. Okay. But it's just okay. All right, fine. Like, it's nice. It's beautiful, but okay, I'll come back to it. All right. Arbitrage-free valuation of fixed income instruments. Okay, do we get this one over here, guys? Arbitrage-free valuation, right? What does this mean? Explain this one. Yeah, well, equilibrium. But the point over here is like, remember, at the end of the day, the market has a price, and you have an independent way of arriving at the price, right? Okay. So now the question is, right? Do you get to the same values? Okay. What you do is, like for example, a bond, a 10-year bond. What do I do with the 10-year bond? I'll value the future cash flows, right? At the 10-year yield to maturity, get a price, easy. But if I were to reconstruct that bond, reconstitute the bond using, for example, strips in the market, so other zero coupon bonds, a 1-year zero coupon bond, 2-year, 3-year, 4-year, 5-year, up 10-year, I can reconstruct the bond using those instruments. And if I find a different valuation, there's an arbitrage opportunity. Okay, so that's kind of an example, right? Got it? There's a market way, the market determines the price. There's also an independent way of actually getting back to the price by replication, right? You guys did this in derivatives, right? That's how you value a derivative, by setting up the replicating portfolio. Yeah, everyone happy? All right, cool. Okay. Okay, so we're all happy with that one. That's fine. All right. Interest rate. Okay, so these 3 diagrams, right? First of all, before I touch on why we use them, everyone comfortable with the construction of them? Right? You all know how this works, right? It's very different to your equity derivative section, right? Here, what's the probability of an up move? 50%, right? All right, cool. Cool. All right. Valuation, how do I value bond off the tree? Everyone happy? So what's the procedure? What do I first do? I first construct the interest rate tree, right? Once I got the tree, okay, I leave it there. Then I look at the bond, the bond itself, right? Okay, now, everyone happy that at this time period of it, if it were a 2-year bond, regardless of where I am on the tree, the price will always be 100? Everyone happy with that? Why? Because the bond matures here, right? So the cash flows are going to be par plus the coupon, right? Regardless of where interest rates are. All right, cool. So then we not value, right? I know what the cash flows are. So this is the terminal values on the bond, right? I find the expected value here. How do I find the expectation? 50% of this number plus 50% of this number because of the ups and downs. And then I discount it at this forward rate here. Everyone happy? So I get the value at this point. Agree? And the same thing over here and repeat the procedure. So backward induction, right? Cool?
Is this standard deviation thing?
Yeah, volatility. Yeah, so volatility will be in determining these things.
Or in determining the interest rate? Okay.
Correct.
Would they also calculate this?
Of course, yeah. Yeah.
Okay, also in floating rate and a normal call bond.
Okay, so valuation. This is straightforward, right? This is nothing fancy. It's just a bond using the tree done, right? Easy. The issue probably will come like, okay, with optionality, right? And there's an option now embedded in this thing, right? You guys, is that a question now? You guys want to understand that one?
That's in the next chapter.
Oh, next chapter. My bad, sorry. Okay. You had a question of the floaters. Oh, next chapter. Okay. So for that bond example, everyone comfortable with the procedure, right? If we're given this situation, do we know how to value the floating rate instrument? So they're giving us the forward rates, right? Remember, at the end of the day, this tree is describing not spot rates, describing forward rates. Okay? This is a forward rate. Okay, so the 1 year spot rate is a forward rate. This is the forward rate for that period, and that's a forward rate for whatever else. I've got the forward rates. If I were valuing a floater, these forwards I'm going to use to determine the floating cash flows, right? You agree? That's why you see that popping up over here somewhere in the valuation. And all I'm doing, again, as normal, I am finding the expected value here, so I collapse all the risk, and then I discount it at this rate. Expected value, the discount at that rate, expected value, discount at that rate. That's the procedure, it never changes, right? But just bear in mind, what also happens, do not forget to always add your coupon. Oh, you guys know that. Okay. Yeah, okay, that's fine. Okay, so, in the absence of volatility, very important, right? We'll always go and use the DCF model, right? No problem there, right? Assumptions of the DCF model that you're going to hold it to that particular maturity. Okay, everyone happy, comfortable? When I do have volatility, right? Okay, I need to ask the question, right? Does it affect my valuation? If I have, no, not always, right? If I have a plain vanilla bond, right? No optionality embedded in it, right? Does volatility affect the valuation of it? It should not, right? If I hold it to maturity, I know they're going to get the cash flow here, I can make the valuation. So everything you've done up until this point over here, where's this thing? Oh, doesn't matter. The point is, for that, it will not affect the valuation. Now, if I have a situation where someone has issued a bond with an option embedded in it, right? Like a callable bond, a puttable bond, etc. Right? You know that those options themselves, right, will for them to they will be exercised if a certain event happens, right? But for now, right, just forget the fact that it's embedded. It's about the path of the interest rate, right, that will affect the valuation. And the minute that the path matters is the volatility that comes into the picture. Because why? Volatility will drive what direction the rates are going to move. Right? This is why the models that we skipped over, that short rate models, that's why they're beautiful, because they describe all that, but it's fine. It's fine. Okay.
How long will it take you?
No. It'll take me a while. It'll take me a while. If you're interested, I can explain it, but it'll take a while. But it's really nice to understand how it all works. Okay. You now understand the process of backward induction, right? Now, okay, so this, at the end of the day, guys, right? We use a binomial tree. A binomial tree is a model. It's a valuation model. Everyone agree? Like you guys have done for valuing options, right? It's a valuation model. The minute we have volatility affecting interest rates, right? Volatility dictates what direction rates will take, right? Right? We start to then, okay, we can't use the traditional discount cash flow sort of approach. We have to value everything off this binomial tree, if you want to call it, right? Okay, now, if I just draw a simple thing over here. Okay, so how many different, okay, so I start here, right? Say this is time 1, time 2. At time 2, how many different interest rate paths do exist? There are 4, right? I can see that One path is going that way. The other path it does this. Right, one goes that way, and the other one can go that way. Right? And you see there are 4 different paths here. Okay? So time 2, there are 4 possible outcomes. You call it, if you can call it that, right? Each has its own probability. Monte Carlo, right? What it's going to do, right? Monte Carlo is just a more fancy way of doing this binomial thing, right? Monte Carlo is saying, okay, fine. There's a particular path. What probability does it occur with? Right? What's the value of this path? What's the probability? Okay, you find the expected value. That's all you're doing with Monte Carlo. So you're looking at, like, multiple, thousands and thousands and thousands of paths, and you're just taking the average of what the value could be. So this particular path occurs at, say, a probability of, say, 10%. I'm making these numbers up, right? This one over here occurs at the probability of 35. That's 35. Oh, shit. 35, 15, 35, 35, 15, right? As an example. You just basically say, okay, what's the value? What's the expected value? It's the number times 15% plus the number times 35%. You find the expected value. Monte Carlo does this, right, for millions and millions of paths, right? Each of those paths has a certain probability, and all you do is you take the average of it. That's Monte Carlo, right? Okay, but now, okay, we'll leave it there. Leave it there. Right. That's done. Any questions? Oh, I'll explain to you, but not here. Not you. Right. All right, now, so the embedded options, right? Okay, so examples of embedded options you guys have covered. Callable bonds, right? Puttable bonds, and this convertible bond story, right? Okay, now, callable bond, right? What is that? Exactly. So who has the option? The issuer, right? Okay, cool. So now, if you have to write out the value, the equation of value, what would it be? So the value of the callable bond, V, is equal to, right? It's the bond of a plain vanilla bond, right? Minus a call option. Everyone happy? Okay. This is the valuation from whose perspective? No, from my perspective, the investor's perspective. This is why I've written the option, right? Got it. Okay, cool. Now, the question is, right? How do I value this thing? You can do it separately, right? Another way would be to use the tree, right? Because I can use the tree to determine this value, yes? And then if I want to determine what the value of the option will be, I just then subtract the price of a vanilla bond, right? This have the same characteristics. Everyone happy? Sure? All right, cool. So now, as always, we draw the tree, right? Okay, so we draw the tree. It has rates, right? This is like the interest rate tree, etc. Now, the problem we have is, right? How do callable bonds work? So if I look at the price yield relationship for callable bond, how does that picture look like? Okay, so a vanilla bond looks like this. Everyone happy? Right? So this is your yield, and this is your price. But for a callable bond, what happens? So as the rates fall, the bond is called, right? So it goes like that, right? Roughly. So at some point over here, right, as the yields are falling, right, you see the bond no longer behaves like a bond, it behaves more like to the sea. No. Right? Cash. Cash. How does it behave like cash? When the issuer calls a bond, what does he do? He gives you cash to give back the bond, right? So when the bond is called, you as the investor, what does your position look like? You're sitting in cash. If the bond is not called, you're sitting in the bond. All right, got it. Now, from this graph over here, you can see, right, as the yields are falling, the bond will be called, right? So there's some level here, right, where you compare the price of the bond to the price of the strike on the call option, right? Now, when the callable bond is written, right, whenever it's sold, they'll tell you the call price will be this amount. That means if the price of the bond had to be higher than that amount, the issuer will call the bond back. Make sense? Now, how do I do that in a tree? I have to use the tree to value a bond, right? How would I do that? So I would compare, exactly, I would compare the value of the bond at each node, right? So it's like the calculations you guys have done before, right? Where I find expected value, discount, all that stuff. I'll compare the value of the bond at these points to the call price, right? And what do I do? Right, exactly. So if the call price is higher than the price of the bond at this point, right, the issuer will call the bond back, right, and you will get the strike price on the bond, right, which is the call price. So you'll replace the price at this point with the call price. Make sense? Everyone? And same procedure as before, expected value discounting. So the only step that's extra in the valuation, right, is the fact that you have to test at each node exercisability, right? Does the issuer exercise his option? Yes or no? What is the price of the bond relative to the call price? Take the minimum of the two, because that's essentially what's going to happen, right? If something is valuable to you, the bond's valuable, you get screwed because why? He will exercise the option and give you cash, strike price, and you give back the bond. Everyone happy?
Each node will depend upon the type of options, right? If it's European or American.
Okay. Guys, the question will tell you, exercise the call option, the bond can be called at time 1 or time 2. That will be in the information. So you'll always test. If they tell you the bond will be called at time 1. So you do all your stuff over here and you continue as normal. But when you get to time 1, compare the price of the bond at these points to the call price. And then replace them, right? If you need to replace it because the bond will be called, right? If it is. And then again, you apply the same procedure. You find the expected value and then you discount.
A call, so we are saying the value is either 100 or more. So if at each node then I'm getting less than 100, I'm using 100 then as the minimum.
Okay, well, so a specific example, right? Say the price of the bond here was 97 and the price of the bond is 110. The call price, right, the strike price, right, is 100. Okay, so what will be the value up here? 97. I take the minimum between 97 and 100, right? Everyone happy? What's the value of the bond here now? It's going to be 100, right? So I'm going to replace the 110 with 100. So I'm going to have 97, and now it's going to be 100. I find the expected value again as normal, and then I discount. You can see, I'm just replacing the values at the point of when the bond can be called. Now you're right in saying that this European, American bullshit, it's the point is, right, they will tell you when the option will be called, right? So if they say it's called here, right, it doesn't matter. You just check the exercisability, and then you go and you move on. That's all. Okay?
One question.
Yeah.
When you do that valuation, you add the coupon again at that level.
You'd have to. Yeah.
But why? Because if they pull over the bond, then you went in at it.
Okay. What direction are you valuing the bond from? Here to there, or from there to here? Backwards, exactly. So this event will occur after, and then you get. So you have to always think about what this is happening in the future. So the bond will be called, yes, but remember you held the bond for this period. The coupon is determined on the period you held the bond for. So you have to get your coupon. Agree? So you get your coupon plus the redemption, because the bond will be redeemed. You get the call price back, right? Okay. Right. That's style. Any option, right? Anything, whether it be a puttable bond, callable bond, exactly the same procedure, right? You are always going to value the bond, move down the tree, and then test for exercisability. Now, callable bonds, we covered. What about a puttable bond? What is that? All right, so in terms of, if I had to write up the value of the puttable bond, it's equal to?
The bond, 3 bond plus.
The put, right? Okay, cool. So this one over here gives you the right. Who has the option here? The bondholder, right? Bondholder's got the option, right? And what has he got the option to do? Buy back.
No, sorry, to sell back.
To sell the bond. Yeah. So essentially what he does is he creates a floor in the price. So as the price of the bond is, it's a put option. Put option you only buy if you expect the price to fall, right? So you've got a put option. So what you've essentially done is, if the price of the bond is falling, you can exit the bond at a fixed price, right? So again, going back to the price yield graph, always this is so important. These pictures. All right, this over here, right? So what do you expect this one to look like? So at some point, right? Remember, the higher the yield, the lower the bond price. So this put option is going to basically live in this space here. You agree?
Yeah.
Right? Now, at the lower yield, it behaves like a normal bond. No issue there. But as the yields start to increase, right, the price of the bond is falling. So at some point, I'm going to exercise my put and sell the bond back to the issuer and get back cash. So this line is in the pull and it's in a eventually behave like cash at some point. So we draw this thing here, so you have the normal bond price. At some point, it becomes cash. You see? Now, this over here, the put, this is the strike on the put option. It's cash you receive versus where the price of the bond would be if you still held the bond, right? Make sense? All right, cool. So this is the valuation. You're going to use the tree to determine this guy, right? And to determine the value of the put, we just subtract the price of a vanilla bond, the same terms.
Yeah, you're right. Setting back the
Oh,
value of the.
sorry. Yeah.
You subtract this. Okay. Right, cool. Conversion privilege. Okay. Okay, fine. Right. Tweak account valuation. Provisions, you've done this one. Done this one. Convertible bonds. Quickly, just touch on that one. What is a convertible bond? Right, it's the option to convert the bond into equity, right? We haven't covered the valuation, and that's not important, but essentially, right, at least the idea over there is that you would convert the bond into equity, right, if... No, actually, you buy the higher price, you convert the bond into equity. Why? Okay, so you convert into it, right? If you think that the value of equity, well, at least there's a strike level on the convertible, right? You are holding a bond, it still pays you interest like a bond would, right? At some point, if the equity price is going up, right, there's a conversion privilege that you have, right? You can convert the bond into equity. If you feel that there's more upside in the bond in the equity, right? But there's more value in converting into equity than holding a bond, you convert, right? But you only can convert when the parity values of the bond and the equity are the same. When I say parity value, I mean that the value of the bond, right, is equal to the value of the equity. So there's some sort of threshold that you must cross first before you can convert, right? Okay. Okay, one touch cocoa is unimportant. Right. Any questions? None. Right, cool. Right. We spoke about this one. Summary. Everyone comfortable with valuation of callable and puttables? Yeah? Okay.
With the convertible bond, how does anyone know when that event occurs? The market dictates.
No. So when the bond's issued, you have what they call the conversion, there's a conversion ratio that's set. So it's saying, okay, fine, if you had to issue, say, 100 par bonds, right, 100, they can, say, for example, the bond is at 100, right, and the stock price today is equal to, say, 40 of the company. So the conversion ratio is equal to 100 over 40, which is what, 2.5. So essentially what you're going to do is you're going to say, well, okay, that means for every 1 unit of bond, I'm going to have 2.5 shares. Okay, fine, that's set today. Now what you're going to do is you're going to say, okay, in the future, right, you set the, there's a, what do you call it, what do you call that thing again? The conversion price. The conversion price will be basically what the conversion ratio is multiplied by the stock price, right? This over here is set. So you compare this value to the value of the bond, straight bond. The minute that this thing is greater than the value of the bond, you will convert into equity. Because why? The value of equity is worth more than the value of the bond.
So it can be at any point in time. As soon as that happens, you can just...
Yeah.
Usually the document stipulates when you can actually the actual...
Well, no, you have, no, as long as, look, you're not forced to exercise.
And I'm talking in practice, like saying the document will say where you can actually do the conversion.
It doesn't have to, eh? Because remember, this conversion privilege is American style. You can convert it when you want to, right? You can convert it when you want to. It doesn't have to always be to think, because the problem is if it is worthwhile to convert now, and then you can't, then you lose the optionality.
Do they issue shares or sell you shares?
That's a step, the issue shares. Yeah.
Look, fine. Like, I think what I'm saying maybe is beyond.
Have you seen some instance where?
Oh no, it's fine.
Have you seen the instance where they do that?
Yeah, there's a list of convertible bonds.
Okay, but that's different. That's a standardized. Okay, I'll come there. Guess we covered this one, we covered that one. Okay, and then, guys, just touching on this volatility story here, right? Because of volatility, right? Remember these things have embedded options, right? So the higher the volatility, the higher the value of the option, right? Everyone happy?
Yeah.
Okay, so for a callable bond, if it's high volatility, what the value of the callable bond should fall, yeah? And for a put, if it's high volatility, the value of the puttable bond should go up, right? Okay. We covered those. Any questions, guys?
Also the duration of the flat
Of a
flat curve expectation.
duration? What do you mean?
Okay, so let me put it this way. Which is more favorable in a flat yield curve expectation? Callable or puttable?
If the yield curve is no, no, if no, I don't understand the question. If you have a flat yield curve,
Yeah,
right? Flat yield curve. Sorry? No, it depends on where the yield is, because remember the yield will determine the price, right? And then obviously if the price of the bond is different to the strike price and the option will you'll convert. Well, I'll come back to your question. Flat yield curve means the yields are the same for every maturity.
So remember there are two scenarios for you to determine which is more exercisable based on upward sloping or downward sloping.
Mm-hmm.
So that makes sense, but when when the expectation is a flat curve, I mean flat yield, somewhere I've seen that the callable is more in the money. I don't get why.
Okay, I'll come back to you. Let me just think about it. I'll come back to you. I'll come back to you. Okay. Guys, any questions on this? Anything? You guys care? All right, cool. I wish I could give you a break, man. I've got much to cover still. Okay, option adjusted spread, right? What is this guy? Right. So remember the zero volatility spread, right? The definition was zero volatility, right? And then how do I calculate it? I can simply use the DCF model. Yeah? Okay. The option adjusted spread, right? Well, the definition is the same, right? It's going to be like some return I will earn, right, in excess of the risk-free for taking on that particular risk. The difference is, right, if there's any optionality, right, present in, for example, these instruments, right, I can't simply go and do a simple DCF model. Because why? The path of the interest rate will dictate if the bond will be called or not. So the option itself will get triggered somewhere in the life of this bond. So you can't simply go and set up an equation of value in discount future cash flows, saying, okay, these cash flows would occur at this time, because why? If the bond is called a put, the future cash flows after it's called a put disappears. Guys got it? So the assumption now of holding it to maturity is thrown out the window. The second thing is volatility dictates the path of interest rates, right? So remember, like we said before, if the volatility is higher, right, what's the likelihood of calling the bond back? It's higher, right? It means that the option, right, to the issuer will be more in the money, right? Or it'll be worth more, and then he will essentially call the bond a lot sooner. So, option adjusted spread, same story. It measures that return you'll earn over your risk-free. The difference is you have to use a model, right, that captures first. You want to try and remove this effect of the optionality before determining what the spread is. Okay? Everyone happy? Okay, so now, how do we do that? Start here. Look at our tree again as normal. Right? I'm just going to draw more nodes here so we can get the idea of what's going on. Okay. Now, this is my tree. Right. Now, think about the bond, this being a callable bond, right? If the volatility increases, right, what does that mean? Right, remember these nodes here, the ups and downs, they are a function of the volatility. If the volatility is bigger, right, the gap between the nodes is wider, right? That means this is a higher, the rates go up, it goes up really like a lot. If rates go down, they go down a lot. Makes sense? That's how it's linked to volatility. This gap here, right, is measuring about the volatility, right, is the gap here, the spread. Now, remember a bond is called when interest rates are falling. So the higher the volatility, the path of rates, right, means that it can go down a lot quicker. So if I have one particular, if I have a high volatility, right? So maybe the bond is called over there, right? Everyone happy? So there's one, at some level of volatility, you find the bond might be called there. If the volatility increases, right? That means that the price of the yields are falling much quicker. That means the likelihood of the option being called, or the bond being called, is higher. Means the bond will be called a lot sooner. So you may find the bond might be called there then. Got it? So high vol, so this is, for example, this over here, call it sigma, right? At this point over here could be high volatility. So the higher the volatility, right, the likelihood of the bond being called, right, is sooner, right? Or is higher, therefore the bond might be called sooner. Now, if you think about the spread that you'll earn on the bond, right? So in the zero volatility calculation, remember what the assumption was? I hold the bond to maturity and I earn the spread, the Z spread, right? Now, in the presence of optionality, right, the volatility now dictates the path of interest rates. Are we happy? Okay, now I have a particular path. The higher the vol, right, now I have this situation where the bond might be called a lot sooner. Think about the period in which you hold the bond for. You're not holding the bond to maturity, you're holding it now for less than maturity. Can you guys see that? Okay, therefore, right, if you had to calculate the return you'll earn on the bond, right, you'll actually earn a lower return, right? Why? Because you're not holding the bond to maturity, you're holding it for less than maturity. Can you guys see that? So for a callable bond, this is very important. So for callable bond, right, the higher the volatility, right, higher the volatility, the lower the option adjusted spread. You guys understand that, the reasoning for it? Sure. Cool. For puttable bond, right, the higher the volatility, higher or lower the option adjusted spread. The higher the spread. Why? Because this is not explained in your notes, but you need to understand if you understand the reasoning for this, you'll understand the reasoning for this. Puttable is what? You're going to sell the bond, right? Okay, so now, oh, one more. Okay, so let's just clean this here. Okay. Going there. So puttable bond, I'm going to sell, right? Now, if I have high vol, I might sell the bond there, right? Happy? And if I have even higher vol, so here's high vol. If I have even higher volatility, right, I may sell the bond over there. But think about what's going on. As interest rates, as the volatility is increasing, and the rates are going up a lot, what's happening to the price of the bond? It's falling, right? Now, if you hold the bond to maturity, or slightly less than maturity, and you sell it, you're going to sell the bond at a significant loss. Makes sense? But over here, if you're exercising the option sooner than expected, you're getting more money back sooner than expected. Therefore, the spread should be higher. Got it? So this is these are the two tables you need to understand, or two things. So the higher the volatility for callable bond, the lower the option adjusted spread. Everyone happy? For puttable, the higher the volatility, the higher the option adjusted spread. Okay. How do you calculate the option adjusted spread, by the way? No. How did you calculate the Z spread? Yeah, you added that Z onto the spot rate. Okay, now, same thing here. I'm discounting this tree. It's discounting cash flows, right? I first find the expected value, then I discount it, right? All these discount rates, these forward rates that I'm using here, I add the option adjusted spread to it, like I did for the Z spread. But for each point over here that I'm going to be discounting, so for example, over here, I discount the expected value here. This point, I discount the expected value there. These rates that I use to discount, I'll add the option adjusted spread, a constant number like I did for the Z spread, to these discount rates, right? So that's the binomial model gives me a way to determine the value of the bond, right? I get the value of the bond, the price of the bond from the market. So I got the market price, then this is now your valuation procedure, and then all I do is I go and I goal seek for the option adjusted spread.
So you need a spread over the forward rate curve, right?
100%. Well, in essence, that forward rate curve is determined from the treasury spots, but it's a spread, but it's constant, right? So it's always going to be, so you can eventually interpret it as a spread eventually over the spot rate curve. It's the excess return over risk-free that you will earn for taking that risk, right? And the difference over here, right? The fact that you can call the bond back, right? So the maturity, right? It's very important here. There's no assumption of holding the bond to maturity. Because once the thing is exercised, all the future cash flows are gone. So this model takes that into account, right? Where? This one? No. It's 2 arrows to say, like, really high. Yeah. So that arrow means increase in vol, like a big increase in vol. All right. Okay. Okay. So here we go. We got that one. Okay. So we got that one. All right. This stuff is not so difficult. It's just, I think in the CFA book and maybe the notes a little bit, but the CFA books is horribly explained. Horribly, very bad. Right? But you just got to draw the pictures and understand what's going on. Okay. Now when it comes to duration, right, people? I just want to show you something quickly. We're all comfortable with what duration is, modified, effective, right? I'm not going to waste time on this, right? But when it comes to this thing about one-sided duration, I just want to go back to the pictures here quickly. Okay, these 2 stories here, right? Okay, so remember, duration is measured. How do I measure duration from this picture? What do I look for? Calculate duration, but looking at the slope of this line, of this graph, right? Duration is the slope of this thing, right? Now, when the bond is called, remember the bond behaves like cash now, right? So it doesn't matter where the interest rates are, you're still going to have cash, right? So what's the slope of this line now? 0. And if the slope is 0, what's the duration? 0. Can you see now how, in terms of, you have to compare the risk now of the callable bond to a straightforward bond, right? It's risky, its risk is lower. Can you guys see that? Okay, so now so they talk about this whole story of a one-sided duration. The 2 bonds behave the same, right? In this space over here, right? Where the yields are high. But as the yields fall, right? The vanilla bond is more riskier than the callable bond. Make sense? Everyone? It's the same story for the puttable over here, right? So the high yield, remember duration, you measure as the slope of the price yield. So as the bond is put, it behaves like cash. Yeah? So you can see that the bond over here loses sensitivity to interest rates compared to when the bond is a straight bond, right? So the riskiness on the puttable is lower than that of a normal bond, right? For high yields. Make sense? For lower yields, the 2 behave the same. Okay? So we get this one-sided duration story happening. Here's all the risk really here. Here, if you compare the 2, the puttable is less risky than a normal bond. Here, same thing. They have the same kind of risk over here, but once the bond is likely to be called, the risk on the callable is less than the risk on a normal bond. Got it? Cool. All right. Okay, yeah, I spoke about this one. All right. Questions on key rate duration? Anyone? Okay, so what's the assumption? I see there's not much to talk about here, but the assumption on duration, right? Right? Duration is what, guys? It's a parallel shift in the yield curve. I can use duration for parallel shifts in the yield curve, right? I use the key rate duration when I consider non-parallel shifts. So what are non-parallel shifts of the yield curve? So we have the steepness, right? The curve steepening up, and we have the curvature, right? Okay, got it. Sorry? Yeah. So we got the parallel, right? And then we've got the steepness, we got the curvature, right? So we use the duration, right? A single risk factor, right? When we consider parallel shifts. The risk factor being the curve shifts in the parallel way. Then we use the key rate duration for non-parallel effects, right? If the curve is steepening or if the curve is, there's a bit of curvature present, right? We're happy. Okay, so how do we use this one? Key rate duration, we identify key rate bonds or benchmarks, like 2-year, 5-year, 10-year, 30-year bonds. Say that's our key rate bonds. All our valuation, our yield curve and everything is centered around what those bonds do, right? Remember, from those bonds, I create the spot rate curve. Spot rate curve means I can value instruments. Now, the valuation is dependent on the yield of those bonds. If those yields change, the spot rate curve changes, my valuation changes. Make sense? So what I can independently go and do is shock the 2-year yield curve, 2-year yield point, measure the P&L effect on my portfolio. Okay, reset that back to normal, go to the 5-year point, shock that, keeping the others constant, calculate the P&L effect, and keep on doing that for the rest of the key rate bonds, and then I add up the overall effect. That will be as if the curve moved in a parallel fashion. If I wanted to just determine, like, okay, if one point moved, the other point moved, I'm able to separate the risk into different components. Cool. Right. Okay, and then the story of convexity. So callable bonds. First of all, you guys understand what convexity is? Convexity for bonds. What does it mean? Let's look in order, but if you had to just describe it. So go back to this graph here. Okay, so pretty much this way. You know, for bonds, if the yield goes up by a certain amount, right, there's a price change. If the yield goes down by a certain amount, right, there's also price change. But do you expect the price changes to be the same or different? Different, right? For decrease in yield, the price change is a lot bigger. For an increase in yield, the price change is a lot smaller, right? So that's the issue of positive convexity. So as the yields are falling, the bond, right, itself, right, exhibits positive convexity, right, or the price-yield relationship. Now, if the bond is called, go back to this picture. Where's that picture? Yeah. When the bond is called here, right, basically the convexity is going to start to move towards net zero. Why? Because why? We're sitting in cash. Cash has got no risk, no duration, no convexity, none of that. But it's moving from positive convexity to zero. Therefore, the convexity must be negative eventually to get to zero. So this over here exhibits negative convexity. For a puttable bond, do you see positive or negative convexity here? Only positive, right? Everyone happy? Right. Okay. Okay, so we as long as you guys understand the tree, we can do this one. This is not too bad. This is not too bad. Okay. Convertible bonds. We know how this one works, right? Okay, so the issue over here, I'll just get back to your question as well. So a bond where the holder has the right to convert into a specific number of common stock, right? Specific number being the conversion ratio that I described earlier. The timing of the conversion is called the conversion period, and the conversion price is a price the bond will be converted at. So the bond price has a value, right? And then you got the equity that has a value. You always compare the two prices. And if the equity value is greater than the price of the bond, you will convert into equity. That's just how the mechanics of it, right? The result of a convertible, you get a benefit from upside in equity, right? The downside is that obviously the bond will have a lower yield. Okay, we'll get to that, right? Et cetera, et cetera. The conversion ratio is the number of shares that the investor will get for every bond held. Much like the calculation I showed you, how to calculate it. You got the bond, and they got the value of equity, right? And on the day you trade the bond, you will determine what the conversion ratio will be. Right? Okay. Okay, so conversion value, it's very simple, right? Is the value of the stock, right? That will accrue to the bondholder. Conversion value can be calculated as the market price of the stock times the conversion ratio. So this conversion value, guys, is the strike price, if you want to call it that, right? I compare this guy to the value of the bond. If this is greater than the value of the bond, then I will convert into equity. It makes more sense, right? Because if you think about it, how this thing works, right? The payoff, right? In simple terms, you always want to take the maximum of what the value of the bond is versus the value of equity is. Okay? That's how it works, right?
Sorry, no, that conversion value can change.
It will change.
Oh, okay.
No, even if the bond price moves, this is also moving. But the minute that this is greater than this,
Yeah.
it'll convert. Right? You see, the thing is, you're right that it can change, right? If now, if it has this American style type of thing, feature. If you're only allowed to convert, like you mentioned, at certain points. So the easiest way to value this is to assume that, okay, the convertible bond is a bond plus a conversion option. When do you exercise the conversion option? At the maturity date, right? So how do you guys value an option, right? A European option using a binomial tree. You calculate the terminal values, right? So you know what the stock prices are here. Then you know if you have to compare that to the value of the bond. What is the value of the bond there? You'll see that it might be the redemption value. Then you'll see, okay, either convert or not, and then you value the option. Okay, that's when you specify one point to convert. But in general, you allow for American type of exercise. Okay, in the tree itself, that you're gonna, if you do use a tree to price it, at each point, node point, you're gonna calculate the conversion value, compare that to the price of the bond. All right. Okay. Minimum value. Okay, straight value, easy. Straight value is just look at that bond, look at the interest that it pays, forget the option. Value the bond as if it were a normal straight, vanilla bond. That's just straight value. The minimum value of the convertible bond, John, remember, you're always looking at this story over here, right? So you're always going to take the maximum of the two. But in essence, if the value of equity is zero, you're going to sit in the bond, right? So you're always going to be somewhere between bond and equity. So at the very least, if equity was 0, you're going to hold the bond. Therefore, the minimum value of the convertible must be the straight value of the bond, must be the bond itself, just the vanilla bond, right? And then obviously the greater value would be the conversion value, right? If you're going to convert it into, that's why I wrote this out. You're either in bond or in equity. Got it? Okay, now, when you convert the thing into your bond into stock, right? You are not converting it at the market price of equity, right? Very important, right? You're converting it at a premium to where the market is. Now, I can't remember the calculation over here, but here we go. Premium of straight value. Here's it here, right? You're basically saying that, well, if the stock price was 40, right? When you convert it into equity, you're essentially paying 45 or something, some price higher than the market price of the stock to convert. So that's why they call it a market conversion premium, right? If you feel very strongly that the equity is worth more than the bond, right? You will convert into equity, but you will do so at a premium. That's the disadvantage of the convertible. But in the presence of volatility, right, you're happy. Because why? It means the equity price will be higher in the future. Right? Everyone happy?
So in this scenario, does lower premium mean you are more of an advantage?
Not say advantage. I don't think it's
Say that you want to
the
be
conversion premium. No, the conversion premium. You'll determine the conversion premium. It will be determined. I don't say added advantage. It'll always be a premium to convert. You'll never convert the thing at the current market price. It'll always be a disadvantage because you always pay more for what the stock is worth to convert.
Going by that equation, because you're trying to
No. It'll always be positive because why? The bond always has value. Then when you're converting, you have to take that into account. It has to exceed this value over here. You got it? It'll always be at a premium because of the fact that because this is an asset, this pays cash flows. This is worth something. As long as this has value, if that were equal to like nothing, then you're just basically holding equity. You'll immediately convert. Because think of the payoff here. If this is 0 and that's positive, what will you hold? The equity. Then you'll convert the market. Right? Okay. Questions? So many different reasons. Agency. Okay. So first of all, it's cheap. Remember when you issue a convertible, right? What are you doing? You're going to share the upside, the future upside with someone. So you're going to issue it at a lower interest rate, right? So the coupons on the convertible will be lower than a typical vanilla bond, number one. Number two, like I said, you're sharing the upside with someone. So someone who owns this bond, if there is serious price appreciation in the equity, right? He'll also want to participate in that. So it means he also wants ownership of the company, whatever, he will convert. Second of all, managing agency costs. So like, for example, if you have a manager or chief executive officer, right, who's very reckless in a sense, like he goes after high volatility projects, you'll be careful now because why? Instead of creating value for equity holders, the convertible over here, right, will basically force the company to issue new shares and dilute existing equity holders. So you'll be more aware of taking excess risks. So manage agency costs, funding, many reasons. A lot of startups use this mechanism for financing, right? Because of the fact that it's slightly cheaper, but also the potential upside is there for whoever invests in it. Yeah, so they're going to share that upside with someone. Yeah. You guys understand from corporate finance the pecking order of how to finance yourself, right? So this over here is like in that pecking order. Yeah. Talk about that one. Okay, so price of a convertible, right, is equal to the straight bond plus your conversion, right, option. Remember, as a bondholder, you are long the conversion option because you will exercise into equity. Now, remember also, you can make this thing a little bit more different. You can also make this convertible bond callable, i.e. the issuer, the guy who issued this bond, can call the bond back, right? So it can also be some callable. And I can have some downside protection. So I can also say, okay, if the price of the bond falls significantly, I want to sell it. So I can also add a put option to it. Yeah, it becomes more structured, yeah. But yeah, so this essentially, this is the general form. So like usually when these things are issued, maybe this is not present, but right, there's a call option, right? So the issuer may force conversion. He can say, well, either I call the bond back, I give you cash, or he'll force you to convert into equity. So you'll decide, you'll ask yourself, well, okay, fine. If I'm being forced now to give the bond back to the issuer and receive cash, right, I face reinvestment risk, right? And if you feel strongly about the equity, you may be, well, it may be the incentive is for you to convert into equity, because why? You'll get a shit deal over here and a better deal over there, right? Okay. Okay, so reasons for, so your question over here, so reasons for actually issuing this, you can see different scenarios when the stock price, what happens to the stock price? So when the stock price falls, right? Obviously for stock, you get a lower return. Why do you get a high return on a convertible bond? Think about the payoff. You're always either in the bond or stock, right? If the stock price is falling, you're going to be in the bond. The bond pays coupons. So the return will be more higher, okay? If the stock price rises, right? High return over here. Why lower return over here? Well, no, you haven't converted yet, right? You're still, sorry, you're still earning a coupon, which is a remember when they issued at lower rates. You are still earning a lower rate, right? And it's still more bond-like than stock-like, so the return is lower. And if the stock price stays the same, right? Over here, low return, high return. Why? Because you're earning interest, coupons, right? Right. All right, that's that section there. Should have got 10 minutes more. All right, I'm gonna ask for a bit more time. Okay, guys, everyone happy with that section of fixed income, right? That had to deal mainly with interest rates. Okay. Now we talk about credit risk, right? So there's two dimensions now of fixed income. One is got to do with interest rates and volatility in interest rates, right? And now the second bit's got to do with specific risk, now credit risk, right? So now if you look at your component of return, like I said, go back to the expected return calculation. We had carry and roll down. We had curve changes. Now we've got credit spread changes, right? Anything specific now to sort of like premium risk, right? So for example, credit, right, is a premium that you'll earn. So if you take on credit risk, you'll earn a premium over risk-free for taking on that particular risk, right? All right, so fine. So some definitions. Everyone happy with default? Right, default's easy. Probability of default is just the probability of default will occur, right? LGD, last given default. So when default does happen, right, what is the actual loss that you'll suffer, right? There's also an element of recovery. So if someone defaults, you get some money back, right? Yeah, someone defaults, and then there'll be some value of recovery. And then we have this thing called expected loss. What is expected loss? It's the probability of default times the LGD, right? Okay, and then if you're more fancy, times exposure default. Okay, the LGD is in the percentage, right? And then CVA is the value of counterparty credit risk, right? Okay, simple. So basically CVA, if you just want to understand roughly, all the expected losses in the future, you discount the expected losses. So CVA is just the value of the future, the present value of expected loss, right? Cool. Okay. Okay, this is not too bad. It's easy, guys. On that next time there. Migration risk, guys. So moving from one rating to another rating, right, occurs with a certain probability, right? If I'm a AAA rated entity now, over the next year, what is the probability that I stay AAA? 93.2%, right? Happy? If I'm AAA, after 1 year I end up being triple B, that's the probability that happens. Everyone happy? Okay, cool. And obviously these are the spreads associated with the ratings. Okay. Does this calculation make sense to you, everyone? Right, okay, where's the confusion? Okay, but okay. So remember from level 1, this is level 2, level 1, right? How do you calculate the percentage price change in a bond? Times the change in yield. The percentage price change in a bond, right, is equal to minus the duration times change in the yield. Remember that? Okay, cool. Now remember that these spreads, credit spread or any type of premium, is always above the risk-free rate, right? Remember, we always looked at the risk-free rate as like as a number, and the risk was if that number changed, right? So think of spread also as a yield, right, and it changing as well. Okay, everyone? Now, this calculation, you see duration times, you see this change here. Now the question was, right, what is the return, right? Well, at least what is the change in return if you were moving from single A to triple A? Okay, got it? Moving from here to here. So now, this is a low spread, this is a high spread, right? So you're gonna, this is a high spread that moves to a low spread. But the point is, okay, so so basically, right, this calculation is what I see over here. It's going to give me percentage change, right? Percentage change in the price of the bond, right? So duration times change in the spread. Got it? So the duration were whatever, 8, right? Times, you move from A, where's the thing? From here, move to there, right? See, this is where you end up, this is where you were, right? This is a negative, negative, and you end up with a positive. Got it? So it makes sense. Why? Because remember, the yield was 1.5, 1.3. You're moving now to 0.5. There's a compression in spread. Compression in spread means that there will be positive price impact. If rates go down, what happens to the price of the bond? It goes up. If the spread went from here to here, it decreased, what happens to the price of the bond? It goes up. So that's exactly what we expect. Got it? Okay. Okay, so any questions on that? That's straightforward, yeah? Yeah, exactly. It's a percentage price change. So I expect now the fact that I move from this rating to this rating, I expect a 6.4% price, 6.4% return increase in my bond position. Correct. Yeah, correct. Okay. Now, that probability of default, right? How do I determine what the probability of default is? Okay. Sorry. Sure. Okay, that's very advanced. No. In simple terms, right? If a company is solvent, right, it means its assets exceed that of its liabilities, right? But if it goes bankrupt, the asset value of the company, right, is worth less than the liabilities, right? You've got to first pay for your liabilities, and then whatever's left over go to your equity holders. Okay, that's the basic sort of intuition. Now, in order to just to sort of set up like this idea of default, right? How to quantify it? Okay, so there are various approaches, right? And we'll come to your method of the hazard rate, right? But at the very basic, we have this thing called the structural model, right? So this is kind of now looking at things in the real world. I know the company, I know the balance sheet, I know the capital structure. I know exactly how the company is financed in terms of equity and how they're financed in terms of debt, right? I model, right, the equity of a company as a call option on the firm's assets. Does that sound familiar? Right? The strike as a call option on the firm's assets, where I consider where the value of the firm's assets are relative to the value of the liabilities that are due over a certain time period. So I value the equity as a call option on the firm's assets. I value the debt as a risk-free bond minus a put option on the firm's assets. Right? Does that sound familiar? Everyone? Yeah? Okay, so the value of equity. Value of equity is a call on firm assets. Okay? Okay, so if I just draw a payoff here, say this strike price is the value of the liabilities that are due, say, in 1 year's time, right? The payoff should be like that. You all agree, right? If the company, this is now the payoff to equity holders. If the value of the assets are greater than the liabilities, the equity holders are happy. They pay off their debt, there's something left for them. If the value of the company is less than the liabilities, company, well, the equity holder has got nothing, right? Everyone happy? Okay, this is now for the equity holder. This is the payoff, and then this is your firm assets. Now, for debt, how does the debt story look like? Okay. At some point, your debt holder, right? If the value of the firm's assets, so for example, now the value of the firm's assets is greater than the liabilities, does your debt holder get paid back in full? He does. Exactly, he does. At some point here, he's happy. But if the value of the assets, right, is less than the liabilities, what happens then? The company's in bankruptcy, right? So what happens is the equity holders, right, they lose everything. The debt holders inherit the company, and they're sitting with the value of the company. So this is why the line looks like that. They'll get the company itself, right? So this is the payoff now for a debt holder. Everyone happy? This is a put option, a short put option, plus cash, right? Can you guys see that? Okay. So that's why I said the value of debt is a risk-free bond, cash bit minus a put option on the firm's assets. Got it? Okay, so for debt, the debt is equal to, I'll call this risk-free bonds. What can I call it? I'll call it, so okay, BRF minus a put, right? On the firm's assets, on firm assets. Okay. Again, what all this means, that structural model I spoke about earlier, right? It's basically doing this. It's saying that you can value the equity and the debt of the firm by approaching it this way. Okay, very simple. Now, did you guys do Black-Scholes? Okay, so now from the derivative section, right? The minute you see now the calls and the puts, right? You automatically know, okay, I have a way of determining the price of those things. I use the Black-Scholes formula, right? Everyone happy? But there's certain assumptions that go into that formula, right? You need to have a constant volatility, you need to have constant risk-free rate, you need to have a log normal process for your underlying, etc., etc. That's all fine. You can assume all those things, right? But in essence, what is it going to give you? One key thing it's going to give you. Okay, so I'm going to write down a formula, right? And tell me what the terms mean. So for call option in Black-Scholes, right? Take the SS underlying, yeah? There's the ND1 term minus the present value of the strike times the ND2 term. Okay? Right. Everyone happy? Stock price, underlying. ND1, what is this? Okay, it's the delta of the call option, right? Fair enough. What is this one? It's a PV of the strike price, right? What is this term? What's that term? Probability of expiring in the money. This is the probability that the stock price is greater than strike price at the maturity date. Now, take this as an if I have to look at like something that's sort of analog to this. Imagine now, like I said, the equity is a call option on the firm's assets. So this S is like the value of the firm, yeah, and this PV of X is like the present value of the liability that's due. This term is giving me the probability the company will be solvent. Makes sense? Therefore, 1 minus this is the probability the company defaults. Got it? So the probability of default I can now calculate as being 1 minus this ND2 term. That's in your notes, right? I'm sure it's in your notes, right? That's basically it. Now I have a means of calculating default probability based on the value of equity, right? With certain assumptions. Got it? Everyone? Okay. The reduced form model, right? Now this is different. So in the real world, if you had to use a real world probability of default, etc., I'd use structural. The reduced form model focuses on risk neutral probability of default. And that's where the hazard rate story and everything comes in, right? But in essence, what this is doing, it's saying, well, okay, how do I use this? I'm saying, well, the value of debt, right, whatever, is basically the risk neutral expectation, or whatever the cash flow will be in the future, right? Right, over 1 plus, I'll call this thing RS, right? Where RS is random. Now, what do I mean by RS? RS essentially is what? Your risk-free rate plus some premium, right? Now, the premium is for taking on credit risk, etc., 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 right? But this is not random. It's in the future, right? Now, remember this expectation, right? What am I doing with the expectation? I'm taking a bunch of probabilities, and I am taking some weighted average of certain outcomes, right? This premium itself, right, is the credit risk, right? So this sort of framework allows us then to determine what the probability of default will be, risk neutral, right, by approaching it in this way over here. Now, if this is random, it has a statistical distribution. Now, when she mentioned hazard rate and all those things, yes, I make an assumption that default will follow an exponential distribution. Survival rate, right, is linked to some sort of hazard rate, which is a constant number, blah, 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 right? Then I find then that the probability of default, at least the cumulative probability of default, is equal to 1 minus e to the minus whatever the hazard rate was, right, times the maturity I'm looking for. This gives me the cumulative probability of default, right? Risk neutral. Risk neutral. Oh, the hazard rate. Hazard rate. So they'll probably tell you, okay, default is constant for over a certain time period, right? They'll give you some indication what the hazard rate might be. Once you have this, you can get this. Now, another way of getting it, as a very crude approximation, the credit spread on the bond, right, is approximately equal to the expected loss, right? And this over here is what, guys? Is the probability of default times the loss given default. Probability of default roughly is lambda times the LGD. I've given you a framework now to determine how to quantify the credit risk. If I know what the spread is, I can determine the expected loss, which is roughly the same. From here, if I have the expected loss, I know what the LGD is, I can determine what the probability of default is over a short time period. Right? Okay. 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 Now, before I just continue something, I just want to speak about something over here. Okay. In your notes, you got an example of how to calculate CVA, right? I'm just going to talk through it, right? You can follow in the notes, not in these notes, in your other notes. Essentially, what we're doing, if I take a 3-year 0 coupon bond, right? 3-year 0 coupon bond, right? I know, for example, right? If I hold it to maturity, I'm going to get the redemption value, which will be the par value, 100, right? But then obviously it has a value today. But like if I look at every time point in its life, I'm able to determine what the value of the bond might be by just discounting the future value right at that time point. Now remember that if there's some chance of default that can occur, some element of default, right? It will affect the what? I may lose some sort of value of the bond, right? So I basically determine what they call the expected loss. The expected loss gives me an indication of what is the quantum of value, right, that I could lose if default occurred, right? So this is equal to probability of the default occurring times whatever you might lose, right? Very simple. Okay. So now what I will do is I'll say, fine, in the life of the bond, what is the value of that bond? Now obviously it'll pull to par, so I know that I expect the bond's value to start to increase as it gets to maturity. Fair enough. If I know that there is a certain level of probability the bond might default, right, I can then determine what its expected losses will be at that time period. And all I will do then is I'll say, okay, fine. If I know what the expected loss is at those time periods, I can then discount those expected losses to get to its overall value today, right? The present value of expected loss. That present value of expected loss is giving an indication of the value of credit risk. So if default were to occur, that value is telling you this is what I could lose if default occurred, right? And all you're going to do, guys, is say compare that value then to the value of the bond, the risk-free value, right? The difference between the two values will give you the value of the risk-key bond, the bond that is subject to risk. Got it? So follow that example in the notes. Just understand what I just said now, and we'll get to the idea of where we get to the credit valuation adjustment. The CVA is simply the present value of your expected losses. That's all it means, right? If you're exposed to any counterparty risk, to value that risk, we look at the expected loss, and we take the present value of those future losses, then get to a number now.
So in the question, we can either ask maybe for the expected loss of PV or LGD and not expect it to go through the
I may ask you to evaluate. So, okay, question. No, let's do this. Let's solve this problem. Say the present value, the risk-free present value of the bond is equal to 95, right? And let's say it's a 3-year bond, right? And then I tell you that the CVA of the bond is equal to 5. What is the credit spread on the bond? Oh, sorry, and I tell you risk-free. Risk-free is equal to say 4%. What is the credit spread on the bond? That's the question they could ask you, right? So how would I approach this? This is the risk-free valuation, 95. This is the CVA, 95. So what is the risky value of the bond? The risky value is 95 minus 5, 90, right? I say 90, the bond is held for 3 years, is equal to 100. I get the 100 back in the future, yeah? And I discount this, 1 plus, no, just say 1 plus 1 plus. For now, I'll just call this, I'll call this Y, sorry. I'll call this Y for 3 years. Come on, man. For 3 years, right? Yeah? Then when I get the Y, right, it may equal, say, again, as an example, it could equal, say, 6%. But I know risk-free was 4%. So my credit spread is 2%. That's the question I can ask you. Got it?
The previous year you survived, right? It will be based on the previous year's survival.
No. So bear in mind, man. You got,
So the
did
same
we,
example,
did we?
previous-
Oh, I see what you're saying. Okay, yeah. So going to that problem over there, right? Yeah, you have to survive first, then default. Yeah. Okay.
The probability of default that every year will differ based on the previous year's.
Correct. See, in your notes, right, they gave you the probability of default for over a certain time period. What she mentioned earlier was called the hazard rate. So that essentially is the hazard rate. They tell you the probability of default over a certain time period, over a 1 year period is 3%. You know the hazard rate is 3%, right? Then you use this formula, 1 minus e to the minus lambda t, right? And this is the cumulative probability of default, right? So that gives you default, cumulative, and then you can calculate default in per period if you want to. Okay? Okay, fine. Any questions? Have I lost you guys? You guys are comfortable? Happy? Right. Sorry? I'll come speak to you now. Okay, so, all right. Okay, guys, I never got time to go through CDS. Do you guys know how CDS works? I think for the exam, we don't have to calculate anything. It's just the intuition behind it, right? Yeah. It's just theory, right? But everyone comfortable. If you have questions on CDS specifically, you can just WhatsApp me or email me anything specific, and I'll more than happy to answer, right? But thanks a lot, guys. I didn't finish. I'm kind of disappointed, but thanks, Ian. Cool. Cheers. Yeah.
Still recording?
No, the example is on.
The one you just did now of the CVA.
Yeah.
So,
Hey, oh, sorry.
so what's the 2% that you?
Oh, okay. It's a credit spread.
Oh, it's a credit
It's
spread.
a credit spread, yeah.
Oh, that's fine.
So the idea over here is, okay, so you want to calculate what the credit spread on the bond might be, right?
Yeah.
If they give you the risk-free value of the bond, so the bond does not default, and if the bond were to
Oh,
default, this is
okay.
the value, right? If the bond were to default, this is the value of the default.
Okay.
So the actual value of the bond should be the risk-free minus that CVA. So this is the risk-free value of the bond,
All right.
right? The bond will mature at
Because
par.
now you accounted for this. Okay.
Yeah.
Thank you.
Yeah.
I just, I'm battling to understand the actual mechanics behind a normal swap.
Okay.
Like what you're actually doing. I'm already holding a bond. Is that the case?
Okay,
Or
so-
can I trade a swap without having done?
No, you can't, 100%.
Okay.
Remember, at the end of the day, right, you've got swaps are used either to hedge
Yes.
or to speculate
Okay.
or to even like transform sort of cash flows.
Okay.
So balance sheet changes. So as a hedge,
Yes.
right? Say now I own a bond,
Yes.
own a fixed rate bond,
Yes.
right? Right, bond. So now I know that if I just draw my timeline, at time 1, time 2, I'm going to receive fixed.
Yes.
Right? Okay, receive fixed.
Yeah.
Now I'm worried now of interest rates going up. Remember, if I'm receiving the fixed rate cash flows, if interest rates go up, the value of my bond goes down. I'm worried about that. So what am I going to do? I want to try and eliminate that risk. So I'm going to then go into use a swap.
Yes.
Right. So now the swap is, remember, I'm receiving these here. I receive the coupons on the
Yes.
bond. Okay, so now I want to get rid of these bonds, of these coupons. So if I'm receiving my bond, I then will pay the fixed rate, pay these coupons to someone else, and receive floating.
Right.
So over here, I'll pay fixed,
Yes.
swap, right?
Yeah.
And I'll receive floating.
Yes.
So what you essentially do over here is, you know, give away the fixed rate, receive floating,
So
and then you
you've
lose interest
offset
rate. Interest rate risk.
your bond. You've offset your bond.
You still have a bond position because you're
Yes.
receiving floating. You're
And
receiving
I'm
now,
saying you've offset the fixed bond
you offset the interest rate risk.
totally, the interest rate risk. right?
Exactly. And you
now
still
you
have an
receive-
asset.
Okay, and you're going to receive a floating, and you don't pay for that swap.
No, it's
you
done.
Just, it's a contract,
It's a contract. It's done at zero.
and then over time.
Over
you-
time, as the rates move,
So
they will
the
be valued.
rate was at 5%. The first floating rate is 6%. You earned higher than you would have
100%.
earned
Correct.
should you have held the
The fixed rate bond.
fixed rate bond, which means your value of your bond is
Now, for you, as an asset, right, you're getting a better cash flow.
yes.
Instead of earning a fixed 5%, you're getting now 6%.
Okay.
And as rates go up, right, so maybe it goes to 6%, 7%, 8%, you're getting the benefit of a high interest rate.
But your actual bond that you're holding is worth less.
It'll
But
be
it
worth
doesn't
less,
matter
but the swap is
because you're not
offsetting it.
selling it.
You're not selling it, but the swap, so anything you lose on the bond,
Yes.
you're gaining on the swap.
Okay. Fine. And if it goes really high, you could benefit.
Even better.
nicely. So you're almost taking a bet that the rates are going to go higher.
Yeah, if your view is rates are going to go up, then
And if you're paying a floating at the moment, and you're just scared that rates are going to drop,
No,
Okay, you
if you're
do it.
paying floating, you're worried that rates are going to increase.
Do you mind if I just upload Corvus's notes?
Okay, I just want to save this quickly first.
The
is it-
recording.
Now, and I want